cost of capital with the representative question, and now I'm going to go through pro formas. Okay? So pro formas, just to remind you, they're basically a forecast of items on the income statement and the balance sheet. Okay? Where sales are typically assumed to grow at some sort of rate, and then everything is based on those forecasted sales. Okay? Such as cost of goods sold, research and development, and selling general and administrative expenses. Typically assumed as a percentage of sales. Depreciation, typically assumed as a percentage of property, plant, and equipment from the previous year. Interest expense, a percentage of previous year long-term debt. Taxes, typically a percentage of pre-tax income. Okay? Further assumptions? Well, whenever we need to forecast accounts receivable, inventory, and accounts payable, we need to use those ratios. And those ratios are days receivable, days inventory, and days payable ratios, respectively. Okay? Cash is typically assumed as a percentage of sales, and then other random balance sheet items that are typically assumed as a percentage of sales or as COGS. It doesn't really matter so much for these other random items because they're usually a pretty small portion of the balance sheet anyways. Okay? Here are what I would call some important assumptions about how things grow. Okay? So property, plant, and equipment in the pro forma year will be a function of property, plant, and equipment now, plus any acquisitions that we make, minus any property, plant, and equipment that just rotted or melted away, as in it was depreciated on the books. Okay? So that's how it's updated. So if you have $1 million worth of property and you buy another $1 million, then you have $2 million. And if $500,000 worth of that rotted away, then you actually have $1.5 million. Okay? So that's how you update property, plants, and equipment. How do you update shareholders' equity? According to the pro forma balance sheet, you take shareholders' equity from this year, you add to it net income, and by the way, this net income should be T plus 1, constant. Okay? Make that as T plus 1. Minus dividends as T plus 1. So these are T plus 1s. Okay? So that's how you update shareholders' equity. You basically just add net income to the old shareholders' equity and subtract any dividends. Long-term debt, that's typically the number that you have to change to balance the balance sheet. So oftentimes when you make some pro forma assumptions, it's usually the case that the asset side is not going to quite equal the liability plus equity side. So what you have to do is adjust long-term debt. So if you have more assets than liabilities, then you lift up your liabilities to make it balance. Basically, you're taking on more long-term debt to fund that excess of assets. Or you retire long-term debt if the liabilities are greater than the assets. So basically, if the long-term debt had to be increased, we had a funding need. Okay? And if the long-term debt decreased, we had basically free cash flow, and we were able to pay down the debt. The equation for free cash flow, where I'm including dividends, is this. Take your operating cash flow, subtract investment in net working capital, subtract capital expenditures, and subtract dividends. In the lecture from a few weeks ago, I called this the funding need, and I said the negative of that is the free cash flow. Here, I'm just going to call it the free cash flow, but it essentially is the same thing. Okay? Operating cash flow is net income plus depreciation, and investment in net working capital is the difference in current assets and current liabilities minus the difference yesterday. Okay? So I'm going to go through an example here where we're given a pro forma income statement and a pro forma balance sheet. Okay? So suppose it's currently 2011, and the manager gave us the following pro forma information. Okay? We're all numbers in the thousands. So we have the usual substance for income statement items. Sales, cost of goods sold, and so on, gross profit, take away some interest, charge for tax, and revenue. Okay? Then we also have the balance sheet, which does balance. This is the pro forma for 2012, where we have, again, usual suspects. We have long-term assets, which is property, plant, and equipment. Totals 37 million. We have some current liabilities, some long-term debt, and then the rest is the shareholders' equity. Total 37 million. So we're going to ask some questions. So basically, the CEO got this pro forma balance sheet income statement from the manager, and the CEO is trying to infer what the manager has planned based on this information. Okay? So in this example 2, we'd like to figure out what the manager has planned. Okay? So first of all, we're going to assume that depreciation is 10% of property, plant, and equipment. Okay? And so what is the current value of property, plant, and equipment? So this shouldn't be too hard to answer, because, okay, we know that depreciation is 10% of previous property, plant, and equipment, and we know what depreciation is in the pro forma year. Okay? So I'll get started. I'm going to go on to the document camera here. So, to part A. So, like it says in the problem, depreciation in 2012 will equal 10% of property, plant, and equipment in 2011. Right? Yeah. Okay? So we know that, it's stated in the problem. What is depreciation in 2012? Well, if you look at the pro forma income statement, we already have it, right? The pro forma income statement states that depreciation is 2300. So 10% of PPE 2011 will equal 2300. Okay? Which implies that PPE 2011 is equal to 23,000. In part B, we ask, how much does the manager plan to spend on capital expenditures? Okay? So when we look back through our equations, we see that on slide 15, we have that property, plant, and equipment in the future will equal the present plus capital expenditures minus depreciation. Okay? So we can solve for the capital expenditure using that equation. So I'll write out that equation here once more. So in part B, we have that the property, plant, and equipment from 2012 equals the property, plant, and equipment from 2011, okay, plus capital expenditures from 2012 minus depreciation from 2012. It's exactly the equation that was on slide 15, okay? We want to try to figure out what the capital expenditures will be in 2012, all right? So, we know that property, plant, and equipment in 2012 is equal to 32,000. Because if you look at the pro forma income statement, that's what you get. The property, plant, and equipment in 2011 is 23,000. CapEx is what we need to solve for. And depreciation in 2012, well, that's on the pro forma net income statement. That's equal to 2,300. Okay, so this implies that CapEx in 2012 is equal to 11,300. Okay, so that's something that the CEO has learned about in regards to the manager's plans. The CEO now knows that the manager plans to spend about $11 million on property, plants, and equipment. So that's one of the assumptions that was gleaned from that information. Okay? So that's part B. And part C, we have, okay, current shareholders' equity is $21 million, or 21,000 K. Based on shareholders' equity this year, what is the manager's dividend policy next year? Okay, so provide the dollar value and the percentage value of net income. So we need to find out what the dividend is going to be next year. So what equation can we use to get the dividend? So we're going to use the equation that involves updating shareholders' equity, right? It's also on slide 15. So we know all that information actually, except for dividend. So we're just going to use this equation to solve for the dividend. So shareholders' equity in 2012 is equal to that in 2011 plus the net income in 2012 minus the dividend in 2012. Okay? Which implies, well, shareholders' equity in 2012 we have from the balance sheet is 22,300. Shareholders' equity in 2011 is given to us in the question, 21,000. Net income in 2012 is 4,400, 40. And then finally, the dividend in 2012, we need to solve for. Okay? So this implies that the dividend in 2012 is equal to 3,140. So now the manager has figured out how much dividend is being issued. At least what the manager's plan for issuing dividend is. Okay? And so I also asked, what's the proportion of dividend paid out as net income? This is also called the payout ratio. What is the plan? What's going to be the payout ratio? Well, it's going to be the 3,140 divided by the 4,440. Okay? and that's equal to 70.7%, which is actually a pretty high payout ratio. All right, so in part D, we have the current assets this year total $4 million, and current liabilities total $2 million. According to the pro forma balance sheet, what will be the change in net working capital? Okay, so change in net working capital in 2012, first of all, we have that equation as well. It's equal to the current assets minus the current liabilities in 2012 minus the current asset, current liability difference in 2011. Right? And that's equal to, well, we have the current assets are $5,300 from the balance sheet that we were given. We have the current liabilities of $2,600, and then we're given the current assets and current liabilities in the current period in the question, and that's the difference of 4,000 and 2,000. I'm working without numbers and thousands throughout this problem, okay? So this equals 700. Okay? So that's the change in net working capital. And then in part E, well, how much long-term debt does the manager plan to issue to fund the increase in net working capital, additional capital expenditure, and dividend? So basically what we have to do here is find the free cash flow. And I'm asking how much long-term debt does the manager plan to issue, so this implies that the free cash flow will be negative. Free cash flow after dividends. Okay? So, let's just calculate the free cash flow for 2012. According to all these plans. Free cash flow in 2012 is equal to the operating income, or the operating cash flow, which is the net income plus the depreciation, right? Minus capital expenditures in 2012, minus dividends in 2012, minus change in net working capital in 2012, okay?